Hey guys, welcome back to another episode of Technology Looks Good to Me, techLGTM with your hosts Preet, Shashank, and Amol. How are you guys doing?
Good.
So, guys, we were really excited. Hey guys, yeah, Shashank said hi, and Amol also says hi. We really enjoyed your feedback from the last few episodes that we got, and this time we're talking about a very interesting topic that has been making news recently, SPAC. And I think we have two great people who can tell us a lot more about SPAC and why is this making so much noise. And without wasting too much time, let me invite Amol to just tell us about what is a SPAC, because this is kind of new to me also. So Amol, please take it away.
Thanks, Preet. So basically, SPAC has been in the market for some good time, almost 30 years now, right? And SPAC stands for Special Purpose Acquisition Company. The goal of the SPAC is where few of the investors come together and pool the money, right? And the money gets locked for 2 years into a escrow. And the goal of this SPAC is to acquire a company and then take the company to the IPO in a very shorter timeline, right? And this has increased, especially in last particular 5 to 6 years. To give you some numbers, last year itself, the total number of SPACs we had was close to 60, and today already by September,
60.
yes, about 120 companies have gone through the SPAC route.
Interesting. So this is sounds very familiar to a traditional IPO, right, guys? So am I missing something? What is the main difference then between a SPAC and IPO? Then?
I mean, there are quite a few difference there. I mean, by definition, SPAC is also an IPO. Like the SPAC is a special purpose acquisition company. They are formed, and by definition they go IPO before they even have a company which they want to acquire. So it's an acquisition vehicle. So let's talk about like what's the general IPO process. Like if we talk
Yeah.
about a normal traditional IPO. So there's a lot of steps involved in that. Like, of course, you have to be in business for a certain amount of time. You're there, you are making some revenue, some kind of stuff is there. There's a lot of rules and regulation around it. So, I mean, first is you choose an IPO underwriter, like you choose a bank and everything. Then you do due diligence on that. That's the most time consuming process for the founders, for everybody involved in the IPO process. That due diligence, that includes the major part of that the end of the due diligence. What happens is like you file an S1 underwritings. So
You do road shows. There's a whole
roadshows
lot.
comes after that. Like once you
Yeah.
do S1, you file the S1 to SEC, which has all the details about your business, your revenue, and all the things you have done, like who owns how much shares, that kind of stuff. Like a lot of things are it's too detailed stuff there. And then you go on the third step is like you go on the IPO roadshow. Then you after the roadshow you see like what the investor sentiment is around, like who's going to participate in this IPO, because they do a lot of private placements there. And after that you come up with an IPO price, that this is my IPO price. So you can start with like X amount of money, but if you see the sentiment is too much and there's a lot of demand, then you generally jack up your IPO price. And then of course you pick up a date and you go really public on one particular day, and that's when public can start buying stocks on that. And you can see the underwriters can actually price the IPO based on whatever they think about. It's not science, it's probably
Some mathematics also involved, right? What is
definitely.
the interest, general interest
Yeah.
in the market?
Simple demand and supply. The market
Yep.
works on that. Even if you have revenue or not revenue, doesn't matter. Demand and supply is the underlying market forces put the price there. Coming back to SPAC, SPAC, they go through this route of IPO. They already pre-IPO. They IPO themselves as a shell company. So they are kind of you guys might have heard about shell companies. So SPAC is almost like a shell company. They go IPO with a specific kind of fund that they want to raise X amount of money. Less, for the sake of simplicity, I would say they're raising $500 million. And there are a set of management people who actually form the SPAC, and they raise $500 million from the market as an IPO. So So that's the basic difference. So if you look, they speeden up the due diligence because there's nothing to do due diligence because it's a fund. They haven't not bought any company yet. So it's also called there's a term for
So
that.
I'm buying into that fund. I'm not buying into any company yet.
Yeah,
Yeah,
you're basically
yeah,
buying into the fund, and then that money gets locked for 2 years into the escrow,
yeah.
right? And then of course there is a management fees involved, which is about close to 2%, and then 2 million additional. But then the main another factor between the IPO and then also the SPAC is that the accredited investors, for example, can be part of the IPO, right? But that they cannot be part of the normal investors cannot be part of the IPO.
So Amol, you brought up a term, and that is kind of interesting to me because it would be helpful for us to tell our listeners what is an accredited investor. What is like the high level definition of uh, who can become an accredited investor?
So by the SEC standards, the accredited investor is one who actually, as an individual, earns about close to 200,000, right? Or as a household is earning more than 300,000, or have assets close to 1 million, right? And
Got
many
it.
of investors do not fall into that, right, for the obvious reasons, and they
Yeah.
miss out of these amazing deals in the startups. But SPAC, after actually even being a shell company or blockchain company, immediately gets listed, and they get listed at the standard price of $10 in the stock exchange, right?
Okay.
And
Got it.
most of the investors can then actually, common investors can start buying those stocks. And then in the future, when it acquires a very good company, they have a
Yeah.
chance to be part of that journey.
So I mean, if I can just use one of these companies would be listed on, or a SPAC would be listed on NYSE, and I would just go in and buy a $10 share for that particular SPAC.
Yeah, it
And
could
then
start
depending
with,
on the SPAC, which company it decides to acquire, that will totally I mean, the price would be determined based on who is on the other side of this merger, right? In the end, from that, that's what I got from what you guys told me. A SPAC is a quick way uh, to list a company in a lesser price initially, and then based on the merger happening with the company, that might change.
so lesser price. I would like to just for the audience to know that's not probably they are not paying the big fees of IPO fees. So that's the
Yeah.
lesser price. Like stock price doesn't matter actually. Like in the stock price could be based on, of course, demand and supply kind of stuff, and the valuation of the business and everything will come into the picture. From $10 can go up and down, but as
No,
a
I mean the listing price. The listing price has to be. It cannot be more than $10, right? That's the one main thing with SPAC.
Wanted to
Or
keep it
is it
that traditionally, initially, the SPAC used to be listed at $5 or $6, right? But
okay?
now, in the last 5 to 6 years, the standard price has been around $10.
but I think that's more of a industry. Amol, correct me if I'm wrong. Like I think that $10 is like they want to simplify and standardized way of doing business so that it becomes easier to do it. But I don't think there's an SEC rule saying that okay, a SPAC has to be priced
Perfect.
at $10.
That's right.
But
There's
they
no
want to standardize the template. This is like a template. This is how you
Got it.
follow it becomes simpler. That's the whole goal of SPAC, that they want to simplify the IPO process.
and the
Got it. Got it.
calculations too,
Yeah,
eventually.
yeah.
Calculations too, of course. So, so guys, why are SPACs all of a sudden becoming so popular? I mean, yes, they have been there for since the 1960s. There are a lot of companies that have used the SPAC route. But why all of a sudden in the last couple of years have they been gaining popularity? So, I mean, one of you guys wants to, Amol, why don't you tell us, like, why is this happening?
I think one person, Chamath in particular, has been driving this SPAC from
Of
last
course.
few years, right? And then
Yeah.
he invested into some of these SPAC, and suddenly it has got the attention of a lot of VCs from the West Coast. Earlier, the SPAC was only the phenomenon of the traditional finance people in the East Coast, right? And now a lot of big names like Reid Hoffman, Mark Pincus from the Zynga, I mentioned about the Chamath, and now also Virgin Galactic founder, all those are actually creating their own SPAC, right?
Yeah.
So the route to raising the fund and going public has decreased, right? And then also the amount of funding that is available to the founders and to the IPO has also decreased. So that suddenly that has become a lucrative thing for both the big time investors and also the founders.
Yeah. So
Got
why
it.
don't we actually
Yeah.
listen? Like I have a video you want to share. I mean, people on
Sure.
podcast can listen to it. Like, why don't we hear from the guy itself? Like, he was recently on CNBC and he was talking about like why he started this. So let me share.
Is this Chamath, Shashank? Are you
Yeah,
showing a video of Chamath?
yeah.
Okay.
Just a second. Yeah.
Sure.
All right. Here's the video. I hope any people on podcast can listen to it.
Do this with you guys. The news is that IPOB is merging with Open Door, and Open Door will be going public. This is the largest online consumer real estate business in the United States. It's doing something really incredible. And what I wanted to do was take an opportunity to give the viewers a sort of behind the scenes look at how we decided to do this investment. It's more than $1 billion. It includes ourselves, as well as a bunch of very well-known other co-investors. And so I think it's important first, I wanted to just take a step back for you and talk about what this whole craze around SPACs, but specifically what my goals were with IPO 2.0. The reality is that a lot of investors are really shut out from the growth that exists in Silicon Valley and tech businesses. But what I'm trying to do is really democratize that access, find these iconic businesses, help them get public, enable them to grow for long periods of time, and really help build a legacy business. Because if we as investors can be a part of that, then we can basically share in those gains as well. So the setup is that. And so what we did was we started to look across a whole bunch of industries. And one industry that jumped off the page was consumer real estate.
So I'm going to stop there because he's going to talk about like where he is investing.
Invest. Yeah. But this is actually very, these are the exact points that you guys touched on, right? I mean, this was exactly what Amol said, that accredited investors get an opportunity to invest early on into the business, right? And
yeah. So let me compare one thing, like the VC industry versus SPAC, like why you, what's the difference there? Like why SPAC is suddenly gaining so much popularity while VC industry was there and they can actually invest in startups, and the startups were.
Is this, are you doing this comparison because you're looking at Chamath's whole career progression of actually him becoming a VC and then going the SPAC route? Is that it, Shashank?
Definitely. Like if you look at his, like he started his career in Facebook, he made a lot of money there. And then he worked in couple of VC firms. He probably formed his own firm. And he invested in a lot of companies, made good decisions, good investments, and the good number of companies. And there's a progression. Like he has seen, I believe that that he has seen a lot of inefficiencies in that space, and he thinks like SPAC is the next big thing, and that's why he's moving towards more and more SPAC, and he's making it very, very popular. In a quick recap of like how the VC industry works. VC industry works on there like generally two players in that, a GP, general partner, and a LP, which is limited partner. So LPs are actually putting the majority amount of money in a particular fund. So a VC firm goes out and raises money from the LP, and generally the fund life is for 10 years. And these GPs who work for the VC firm, they are the one who decide where the money will go and how the money investment will happen.
Yep.
And the LPs are waiting for 10 years to make a return on it. Generally, after 10 years, they have the legal rights to actually ask for the VC firm that where is my money? Do you have to give my money back with whatever the profit, and if there's loss, whatever it is. So fund liquidates actually, not dilutes, liquidates at the end of 10 years. But you can take extensions and everything. That depends on like a number of and they can come back with. So there's no quick returns there. Your fund is locked up for 10 years. VCs invest in like multiple companies, of course, and that's how your thing happens. Like these LPs own portion of each of the company where the VC firms are actually investing. And of course, to participate in these kind of investment vehicles, you have to, as Amol rightly said, you have to be an accredited investor. So you have to have X amount of assets or X amount of money, like 200,000 or 250,000 or more a year you're making as an individual. Or there are some, like I don't quote on the rules there, go on SEC and find the rules there that either you're qualified or not. But majority of the people are of course not, because the average income in America is like way less than to become an accredited investor. But you, as an average American, you can actually buy stocks. Even if you have $10 to invest, you can buy stocks. You don't have to qualify
Absolutely.
for that. And that's what, like, SPAC is actually a very game changer, because let's say, let's take an example of Uber. Like you, me, and everyone, all three of us probably started using Uber long before it went IPO, and we all saw the value of it. We all had discussions about it, like why Uber is going to take over the market. Like, you don't have to be rocket scientist or a genius to see that Uber is the next big thing. Could I participate
No.
in that? I was not able to participate in that.
Yeah, I think that's a very good
Yeah.
example, because Uber and like that, many other interesting companies, many of the investors, common investors, are not able to participate until the IPO happens.
Yeah.
And then in many of these VCs give a lot of pressure to these right companies to actually go for IPO route. And that takes longer, and their funds become locked for about 8 to 10 years, right, until the IPO happens. SPAC is one vehicle where actually the returns happen almost in 2 years. And if the return does not happen in 2 years, then money locked in those escrow comes back to the investors.
Yeah.
But I'm only hearing good things about SPAC, guys. Are you, is it green always on both sides? Is there no downside to a SPAC? Because otherwise there would be no IPOs, right? There would traditional IPOs. There would be only SPACs. So I'm sure there's something going on that is limiting people from doing these more often. What are the risk factors?
Great question, right? So one of the risk factors that we see is that when the normal IPO route happens, then a lot of due diligence happen, right? And we saw that with the WeWork also when they filed for the S1. Then a lot of traders found some hole in their financials, right? Eventually they have to step back and they did not do their IPO, right?
Yeah.
But in case of the SPAC, the due diligence only relies on those fund managers, right? And then we saw the case with the Nikola just now in
Yeah.
last two. This uh,
Mhm.
the they went through this SPAC route and did the IPO, right? Stock went to from 10 to 14, and just last week it went back to 19 because there are some speculation that their truck was actually not self-driving but rolling on the floor, right?
Oh,
So
oh, genius. I mean, of course, you do a truck demo, autonomous driving, and you put it down downhill.
No,
yeah,
that was a stock going downhill.
Oh,
so
definitely.
So in the SPAC, basically, when the deal happens, there's another investor who can join the deal as a pipe deal, right? So GM was also involved in the case of the Nikola, and now a lot of questions are asked to the GM also, right? Why they invested as well. So when something like this happens, we will see in the future most of the companies will, or some of the companies will actually fudge their numbers to return the value to the investors as soon as possible through the SPAC.
Yeah.
Um, that is inevitable.
I think like more and more like there are definitely advantages of SPAC we talked about, and more and more company will start looking at SPAC route, because as a founder, like ourselves, we are entrepreneurs, and if you ask me, do I want to make my product or do I want to do 6 months of IPO process? I want to focus on my product actually, and then if there's an existing SPAC who wants to actually invest in us or reverse merge, and we become public, I think that's a dream for the founder actually. Now I'm totally focused on the company growth, revenue, and everything, not wasting 6 months, because 6 months is a huge period of time actually where you're actually just focused on IPO stuff. Sometimes it can take more than 6 months to a year actually in the whole IPO process.
Absolutely. For founders, I think, Shashank, you're absolutely correct, right? For founders, it kind of makes sense because if I'm going back to Amol's example, like of WeWork, if WeWork traditionally, it did not go the traditional IPO listing route, and it tried to go through a SPAC route, if that was an option, but that would have been kind of a fraud, right? Because the financial was so messed up,
Yeah.
and we would have ended up getting something that was basically a hoax,
So
right? Because it
definitely,
didn't.
definitely that risk will always be there. I think what is going to happen in next, that's again, I guess, like SEC generally follows. Like we have been Preet, you and me have worked for the banks. We know that how SEC kind of, not exactly like how SEC works, but we know they see a lot of interest in certain kind of vehicles of instrument investment vehicle. and then they start formalizing rule around it. They see couple of frauds happening, couple of things happening, and then they will start tightening it up. So that's what is going to happen in the next few years. I am sure SEC will come out with certain guidelines on like this is what exactly you have to do. That brings me to one point. Like before we end up, like Amol, you remember like you did a lot of ICOs, like helped some companies to do ICOs. Like, and can you tell audiences about like the power of SEC, like what they can do even if you are not actually doing IPO or listing your shares?
Yeah, because SPAC actually completely shows me what's going to happen in the future based on what happened with the ICOs, right? Because ICOs was simply, a lot of companies went through the ICO route. They did not talk to the SEC, just launched the cryptocurrency. And then SEC, after even 2 or 3 years after launching the cryptocurrency, SEC went after those companies, and those companies had to actually pay the fine or return the money to the investors, right? Same thing, I do see that it might happen with the SPAC also, not at that level, but to some extent. And especially with the case of the Nicola, right? When this issue happened in last 2 months, just last week, Jay Clayton from the SEC, he made a statement that there will be more scrutiny and there will be more regulations on the SPAC. So when a particular fund managers, they say that they are going to acquire this company, they have to show and look into a lot of financials and submit into the SEC before they actually, the deal or merger happens. That's a good thing. We need more kind of regulations in this so that less fraud happens. Other example I can see is that with the case of the Rotherwood Ventures, which happened about 3 years ago, the fund was actually misused. And that is a traditional VC route, right? Traditional VC fund. And then SEC went after them, and then he has to pay, the founder of that VC fund had to pay 30 million as a basically money back, right, to the SEC. So there is no way around it. SEC will go after.
So SEC is protecting us. That's what we're getting at. Like whether it's VC, it's private money, or it's the IPO route, or it's a SPAC. So SEC is there, and everybody has to abide by those guidelines, right? So
I mean, also what Amol said is like, just reiterate, like just because you think that you can do flout around like gray areas somewhere, SEC can come back after 2 years or 3 years also and see like, okay, you did something wrong there. You flouted these rules, and now you have to pay back, or you will be fined, or even they can do criminal proceedings against you if you do investor frauds.
Interesting.
Yeah, cool.
So this was actually a pretty informational episode for me. Actually, there were a lot of things that were pretty interesting in these what we talked about. Anything else that you guys would want to add before we say goodbye?
Yeah, I think there was one last thing I want to ask. Amol was mentioning something like there's another could be a next podcast topic. I just want to give a teaser to our audience.
Oh yeah, of
course. There is another new kind of investment vehicle, or I don't know that's the right word or not. Amol, do you want to talk about that?
Yeah, there are two things which is happening in the VC world again. One is the rolling funds. I think we should cover one more topic on the rolling funds. It's something that is becoming very famous. Second thing is, just last month from the Eric Rice, long-term stock exchange has been launched, right? So the goal of that particular stock exchange is to list the companies where they do not have to show the financials every single quarter. But I don't want to speak too much about that. We can actually...
No, we'll keep it for the next episode.
Yeah, we'll keep it for the next one.
Great, so guys, this is a wrap up for today. Make sure you like, subscribe our channel. Check out our YouTube video channel if you want to, because we shared a video also of Chamath actually telling us about SPACs. So it would be pretty neat if you want to check that out. techLGTM is our channel's name, all across major platforms, social media, and it's the same on all leading podcasts also.
Yeah.
So.
All right, guys.
See you guys until next week. Bye-bye.